and also we have discussed make or buy decision. The next example will be combine both limiting factor and make or buy decision together. Right. A Gamagi company makes a product X and the cost structure of its unit as follows. Direct material cost 300, direct labor cost 200, variable overhead 100, fixed overhead 150, total cost altogether 750. But the thing is, this 150 is relevant or not? Since it's fixed cost, normally in the marginal costing analysis, we are not considering fixed cost as a relevant cost. Right here, whether you decide to produce or not of this particular product X, you cannot avoid this cost, right? You cannot avoid the cost. So therefore, this fixed cost considered as a irrelevant cost because you already incurred, spend. The annual capacity of product X is 1000 units. Gamagi company agreed to continuously provide, right? Gamagi company agreed to continuously provide 625 per unit. Unit X to purchasing manager, right? Gamagi company agreed to continuously provide 600. So you can buy the same product outside at 325, right? When you make internally, the cost could be this without fixed cost because we are not considered as a relevant cost. So the cost will be altogether 300, 600 rupees, right? So if you decide to produce the product internally, the unit cost could be 600, and if you decide to buy outside, the cost will be 625. Determine whether the product X should be produced within a firm or should be purchased from the supplier. Right? What is your decision? What is your decision based on your knowledge till now? Is it is profitable or it is viable? It's a good decision to produce internally or buy it from outside. What is your decision? Right? What is your opinion? Anyone? So what is your opinion? None of you? Right, per unit it produces 600 rupees, right? 600 rupees cost. So they have how many units? 1000 units demand. So 600 into 1000, how much? 600,000. 600,000. If you buy it from outside, you may incur 605. So 25,000 we can save. We can save 250,000 when you produce inside internally, right? That is number one. Number two, if the annual fixed cost increased by 20,000 due to the manufacturing of product X, is there any change in your decision? Right. The thing is, right? This is your earlier decision, right? Earlier estimate. Now, if you want to continue product X internally within the firm, you have to repair. You have to repair the existing machine that belongs to fixed cost. If you do so, right, if for repairing of that machine, you have to encounter 20,000 cost, right? The thing is, now this is estimation. The estimation is for how much is the amount estimation. But now at this moment, you can take a decision whether produce internally or buy from outside. Based on the estimation, the cost in relevant cost was 600 rupees per unit. By unit basis, no unit base, we didn't consider this one. But later they realize that to operate the machine, sometimes the machine has been operated for long period. Now they have stopped, right? Stop the production, and again they decide whether decide to buy or make. So the operation manager says to restart the production, the machine has to be repaired. The cost will be 200,000, right? 200,000 fixed cost, not unit entirely. They have to spend 220,000. Then what is your decision? Earlier we know that for 1,000 units of product, the total cost is 600. Additionally, right? Additionally, they are going to repair, no? So repair, so that they will add 20,000. They will add 20,000. So therefore, the relevant cost will be 620. Relevant cost 620. But if we purchase outside the same output, 1,000 units, the cost will be 625. There are no changes. Therefore, again, you have 5,000 contribution you have plus positive. So therefore, still we can produce internally that product, right? You see solution in systematic way. Production cost, production related cost, incremental cost earlier 600 into 10,000, 600,000 units, 6,000 rupees. No fixed cost for the question number 1. No opportunity cost, and here total cost of product when we purchase outside. So the cost saving will be 25,000. The second case, additional 20,000 cost will incur, right? So therefore, the relevant cost will be 620, but the cost still constant 625, then plus 5,000. So therefore, can continue. The third question, like third scenario is about opportunity cost. Opportunity cost. Here, there are capabilities to produce and sell, right? Produce and sell of product Z. Product Z. So, early company currently produce product X, right? By using the same machine, they can produce product Z, utilizing the resources required to produce X. The selling price of unit product of Z 650, and the variable cost of the product is as follows. Direct material to produce 1 unit of Z will be direct material, direct labor, variable overhead, not fixed. Variable overhead 125. Further, an extra fixed cost of 50,000 is also to be incurred to producing Z. 1,000 units of product Z, 1,000 units of production Z also can be manufactured. If information also in 2, that is 20,000 fixed cost. Related, indicate your decision under these circumstances. The thing is that they had to take earlier 2 decisions. Now they have to take at this point in time, they have to take 3 decisions. One is make or buy. Make or buy. Here, when they take make or buy decision, they have to consider that whether they are going to continue product Z or stop producing Z and allocate that machine produce Y. That machine has to be used to produce X or Z. First, they have taken this decision as well, right? The same machine can be used for X or Z. Additionally, if they decided to use that machine to produce product Z, they have to incur additional 50,000 as fixed cost, right? This is the case. Now we'll see, right? So there will be an opportunity cost. There will be an opportunity cost. Why? When we choose X, When we choose X, we will lose profit from Z. When we produce X, we have to lose our profit derived from Z. So therefore, when we make decision, opportunity cost is relevant cost. Let us calculate the relevant cost, especially the opportunity cost of Z. Right? When we choose X, how much will be profit will be lose. Here we know that the variable cost of Z 555, right? 8 1470 and 575, right? 575. Variable cost of Z would be 575 rupees, and it can be sold right in the market. It can be sold for 650 rupees. 650 rupees. Selling price 650 rupees. Then how much profit? How much contribution they can generate? It could be 75 rupees, right? 75 rupees is a unit contribution, right? We have to consider, if we switch from X to Z, there will be an additional fixed cost of 50,000. Earlier we know that they can produce 1,000 units of Z. So therefore 75 into 10,000, it could be 75,000, right? 75,000, and the contribution and the fixed cost also will be relevant. Then if we deduct 50,000, then how much? 25,000 profit. 25,000 profit will be the opportunity cost. 25,000 will be opportunity cost. So that 25,000 opportunity cost also has to be considered when we take decision. Here, variable cost 600,000 of X, and extra fixed cost of X 20,000, and the opportunity cost by choosing X could be 25,000, right? This 25,000, and the total cost could be 645. But if we purchase the same output X from outside, it will be cost 625. So therefore, the amount of loss, right? Amount of loss here 20. So while we when we make the product X internally, we will lose 20,000 profit, right? So therefore, the decision would be buy from outside, right? Not produce, buy from outside. Is it clear? Is it clear, the situation? Please give your, right? Is it clear? Is it clear? Please let me know if you have anything, please. Okay, no one is responding. Anyhow, right. So if we have any gray area, please let me know, please. Now we will combine make or buy decision, right? Make or buy decision with limiting factor, right? Already we have discussed limiting factor. We combine the limiting factor with make or buy decision. The VPS company produces 3 products, A, B, and C. There are 3 products using the same type of machine. Very important, the same type of machine. It is expected to produce 400 units each. We will make it 4,000, right? 4,000 units, 4,000 units, and sell next week. So there are demand. There are demand 4,000 A, 4,000 B, 4,000 C, 4,000 C, right? The information related to unit as follows. To produce 1 unit of A, the machine requires 3 hours. To produce 1 unit of B, it requires 2 machine hours. To produce C, it requires 4. The variable cost of production of A, 20, 36, 24. The selling price of A, selling price 35, 45, and 40. The number of machine hours during the next year is restricted to 20,000 hours, right? Machine hour 20,000 hours. SVP company agreed to supply, right? So our company is VPS. The SPV is outside company, third party company, agreed to supply each product according to the following prices. So 29, 40, 34. If we produce internally, we can make it 20, 36, 34. Same product from outside, this by input. Right. Here they have to decide, determine the production plan which maximizes the profit of the company. So normally if we have limiting factor without make or buy decision. So what is the step number 1? First we have to rank, we have to rank. So on what basis we rank? On what basis we should rank? Anyone else? We discussed in the last class. Anyone? So what is the basis of ranking a product? Anyone else? Inshaf? Are you there? Inshaf Mohammed? Are you there? Madhushani? Sabasekaran? Can you hear me?
Hello.
Yeah.
Based on contribution?
Yes. Based on the contribution. Right. Very good. That's the exact answer. Right. So we have to, there are 3 products and we have 1 limiting factor. So what is the limiting factor here? What is limiting factor here? Which factor limit our production?
Machine hours.
Machine hours. First we decide actually the machine hours is a limiting factor. Here to produce 1 unit of A, we require 3 hours. So we have 4,000 demand. So therefore, how many hours it requires? How many hours? It requires 12,000 hours. It requires 8,000 hours. It requires 16,000 hours. So totally we need 36,000 hours. We need 36,000 hours, but available hours 20,000, right? 36 hours we need, but we have 20,000 hours. Then we have shortage of 16 hours. And after that we order, right, based on the contribution. Here how much contribution? 15. Then how much here? 9, and here 16 contribution. Accordingly Then here machine hours. So based on this, which one is more preferable? Your rank, can you rank it based on this? Can you rank it for A, B, C? Which one the best? So here we can divide 16 by 4. This is 4. 9 divided by 2, 4.5. Here 5. So which is rank number 1? 5, 4.5, 4. So what's the rank number 1? First we have to allocate to which product? Labor hours, preference. Which is rank number 1?
A.
A. Then A. Then
B.
B. Then C. Right. So if we have no option to buy the product outside, so this order is correct. This order is correct. But you have an option to buy the product outside, then you have to think about you have to think about the saving, right? Cost saving. For what? Cost saving. Cost saving mean when you produce this product internally, you may incur 20 rupees. But if you buy that product outside for 29, the cost could be how much cost? 20 cost. Here cost is 36. Here your cost is 24. Right. From this, how much your cost saving when you decide to produce the product internally? When you produce a product A, how much you can save a product? For A, how much saving? Cost saving? 9 rupees. Very good. 9 rupees. Very good. 9 rupees saving. Right? Saving. Saving 9 rupees. Here, how much saving?
Be 4 rupees.
4 rupees saving. Here, you're saving
10.
10 rupees saving. Right. Now we have cost saving. Right. Now we take the machine hours. Right. To produce a product, it requires 3 hours of machine. Here it requires 2 hours and it requires 4 hours. Right. Then how much saving per limiting factor? Saving, cost saving per limiting factor, how much? So this is limiting factor. Then how much when you save, right, 3 hours. So when you use 1 hour, how much you are saving? You're saving how much? When you operate the machine for 1 hour in product A, how much you can save? 3 rupees. 9 divided by 3, 3 rupees. If you allocate that machine to produce product A for 1 hour, it will give you 3 rupees. Then how much B? B?
2 rupees.
2 rupees. C?
2.5.
2.5. Now can you rank which is more profitable for our limiting factor? The rank
A.
A. You have to, yes, you have to choose A first. then C second, and third one C. Right. Now let's see, we have 16,000 hours. We have 16,000 hours. We have 16,000 hours. Sorry, 20,000 hours. We have totally 20,000 hours, and we need A, B, C. We have 4,000 demand for each, 4,000 output. A requires 3 hours, 2 hours, and 4 hours. Right? 3 hours, 2 hours, and 4 hours. Yes. Now let's see, based on the rank, we have to produce 1, second, and third. This is the ranking. We allocate the resource. First, we can produce A. We can produce 4,000 demand we have. So each requires 3 hours. Therefore, 12,000 hours. 12,000 hours belongs to A. Right. So totally we allocate. So balance 8,000 hours remains. 8,000 hours remain. The second option, the second rank will be C. Right. C. For C, right, it requires to produce 1 unit, it requires 4. Then 4 hours. Then it should be 8,000 divided by 4. They can produce 2,000 units. 2,000 units. So this is the allocation. This is the allocation. So they can produce A 4,000 units, right? And C 2,000 produce. Then market product, right? The market product. So the market demand. The market demand is 4,000, but we able to produce only 2,000 of C. Then balance 2,000 will be purchased from outside. This is buy. This is produce. Right? This is buy and this is produce. And B, we have no labor hours, machine hours, so we can't produce nothing. All 4,000 units will be purchased from outside. So this is the product mix. This is the mix. So they have to decide 4,000 units of A and 2,000 units of C has to be produced internally, and by outside 2,000 of C and 4,000 of B, right? Then we will see the profit or profit. Right? When we produce A internally, all 4,000 will be produced. So therefore, per contribution, for unit contribution, how much? Unit contribution could be, right? Unit contribution will be, it can be right, sell at 35, but variable cost 20. So here we have 15 rupees, right? 15 rupees. Yeah, the total contribution, right? A contribution 15, 60,000. B, right? B, we purchase it entirely from outside, right? Entirely from outside. So therefore, you see the selling price of B, right? Selling price of B is 45. Selling price of 40, and it can be purchased from outside at 40 rupees. It can be purchased from outside. We have no resources to produce inside. So if we produce internally, the cost could be 36, but we decided to buy outside. So therefore, buy 40 rupees per unit. So contribution 5, right? 40 minus 45. So here 5. We have to purchase entirely the B outside. So therefore, the cost, the contribution will be 20 from B. And the C, we decided to produce 2000 internally, and the contribution, right, 16 rupees contribution, and another 2000 will be purchased from outside at 34 rupees. Therefore, the contribution will be 6 altogether. Total cost could be 164, and the information is given 60,000 as fixed cost. Profit will be 64,000. This is the product mix. Right? Clear? Is it clear? Okay. Now we move. Right? Now we move the next part. Accept or reject specific order. Accept or reject specific order. What does it mean? Special order. Special order. What do you mean by that? Anyone else voluntarily? What do you mean by special order? What is it? Special order?
Seasonal orders like that.
Yeah, additional order. So sometimes some customers request a demand, right? A bulk order, bulk. Then they demand that the price lower than the market price. Right? They demand lower than the market price. Say, for example, a product X can be sold in the market for 50 rupees. But a customer comes to the shop and they demand, I want 10,000 units. I want 10,000. Can you give me a reduced price? Then he demand for 40 rupees. Market price is 50, but he demand for 40 rupees. This time, do you accept or reject his special order? That's the case here. Right? Special order is the special quantity of demand. Special quantity of demand made by a special customer to a firm in addition to existing market demand. Right? Existing market demand. This is mainly in two forms. Ability to complete the order, right? Ability to complete the order within the normal production capacity of the firm. So they have already everything. They have everything to produce whatever the demanded by their customer. That is number one. Number two, inability to complete the order within the normal production capacity of the firm. That is necessary to extra production capacity to complete the order. Sometimes they may purchase additional machine, or they have to make additional labor cost, shift workers. They have to provide overtime. So that time the cost may be varies. Number one, look at ability to complete the order within the normal production capacity. Right? In the normal production capacity, no issue. Here, additional sales value obtained by accepting the special order is more than relevant cost. The accepting such special order. We'll see what are the things. Variable cost and fixed cost. Variable cost here, the variable is may include material cost, labor cost, like that. Opportunity cost, sometime, right, when you accept the special order, here the case, you are the market monopoly, right? In the market monopoly, you are producing a product X. This is your product. You have customer base of 50,000 units. You have 50,000 units. You can sell in the market. You are the only sole supplier. A customer, right, customer Y approach you and ask you some of its product. Then he is going to sell that product in the same market. Then there will be a competition between you and your customer, right? The X, right? X directly market the product. Y also going to market the product. He purchased at lower cost from you and he is going to sell in the market. Then the customer having two options. either buy from you or buy from your customer. This time, before this accepting this contract, you had a 50,000 customer, 50,000 sales. Now, by selling the product to Y, right, he also come to compete in your market, and he may affect the market share. He also will take some of the share of the market. Then you're unable to sell all this 50,000. Then your sales will be go down, say 35,000 or so on. Sometimes the Y can perform better than company. I'd say here they may in the product they put say 250 rupees. Right? You sold this product to Mr. Y for 150 rupees. The maximum retail price is 250. Normally you sell this for 250, but the particular customer purchase this product from you for 150, and he can sell this product for 200 rupees with 50% 50 rupees discount. What will happen? What will happen? This time your sales, right? Your sales fall down dramatically. That's why, right? When you buy some product from company outlet or showroom, price is high. So showroom price may be 10,000 showroom price, but you can buy that product from outside, same product produced by the same company. We can buy it for 8,500 and so on. Always the showroom price is high, and then the external. Why is that? The company sell this product to this customer, and he to attract its customer, they may do some promotion, some discounts. They will give some discount, right? Then the showroom sales go down dramatically. That's what it happens, right? So very careful when you accept or reject an order, new order, special order from a customer. Then second thing you have to talk about, this is opportunity cost, right? This is opportunity cost, what we talked last time. The necessity of extra production capacity. Sometimes to accept a new order, you may have sufficient capacity. You have to give some extra fixed cost, or you have to give some extra shift to the labor, right? So that time also you have to consider this cost as well. So those two are the relevant costs. Let's see one example. Ratnayaka company manufactures a product X and sell it for 60 rupees per unit. Variable cost is 40. Right? Selling price 60, and variable cost 40. Then contribution will be 20 rupees, the contribution. Gajanayaka company placed a special order of 1,000 units, special order for product X, and agreed to pay 45, right? This time, do you agree or not? This price. If no other information is given to you, right? No other information given to you. This time, do you accept this special order or not? At this moment, forget about these details. Forget about this. Here, so you have only this information. So now, do you accept or not this special order?
Acceptable.
Accept. Why is that?
5 rupees margin is there. The
Very good,
contribution
very
is
good.
there.
So that's the point. That is the point. What is the minimum price he can offer Ratna company, what's the minimum price he can accept? Until its contribution goes to 0, right? If they ask for 40 rupees, 40 rupees. So the cost at cost. Most probably they will not accept the product. Most probably, or sometimes they may accept because for the employee, the company has to give some salary to its employees. Even though the workers are worked or not, they have to provide some job opportunities so that they can sometimes they can agree to provide that product for 40 rupees. But below 40, say if they provide the product for below 40, they can't give it because it gives them a negative contribution. So that time they cannot accept. So up to maximum price they can give 40. Right. So this is the case. Right. Now, however, it is noted that the special order is accepted. The present demand of the company is brought down by 200 units. Right. The thing is, we can sell 1000 units to the special order, but when you accept that, you may face a fall in demand of 200 units. So that how much you will be lose? So each unit you encounter 20 rupees contribution, right, per unit when you sell the product for your own customer. But this customer, right, special customer, right, can sell the product in the market. Due to that, you lose 200 units. So that per unit 200 into 200, 220 rupees. So there will be a 40,000 loss. This is called opportunity cost. Opportunity cost. By accepting new order, you will lose contribution 20 rupees each. So there are 200 customers. So you will lose 40,000 as an opportunity cost. Opportunity cost. Here, let's see. Right, the special order 1000, special order 1000, and you can sell it for 45 per unit. So therefore, you can earn 45 sales revenue. This is revenue. Relevant cost to produce a unit. The variable cost is 40 rupees. 1000, therefore 40,000 variable cost. Variable cost. Now opportunity cost. Each 20 into 200 units. Sorry, 4,000, right? Only 4,000 is opportunity cost. Or 4,000 opportunity cost. Right? You lose. Then the total relevant cost. Total relevant cost could be 40,000 variable cost, 4,000 opportunity cost. Altogether, we have 44,000 cost. So therefore, you can make 1,000 rupees as a positive contribution profit. Positive contribution. Therefore, you can accept the order. You can accept the order. Right? Is it clear? Okay. Right. The assumption is there is no additional fixed cost to be incurred in accepting this special order. Right. Then shutdown operations. Some of the branches are not performing well. Not performing well, and they are encountering loss. and they may decide to close down a particular branch. Or the company produces multiple product ABC, right? Multiple product. Then product C give us a loss. Then they may decide to close down the C. So is it possible or not? Right? It's a good ideal option or not? Here, the decision taken by the comparison of the sales revenue received by making a relevant product, or by maintaining relevant division with relevant cost, by making a relevant product or by maintaining a relevant division, right? So here also always relevant cost are included cost. It's include variable cost and fixed cost, additional fixed cost, right? And the opportunity cost. We'll see. So this is the scenario. Please read it within a minute. Please read this and understand the scenario. Please read at least 2 times. Right. XYZ company produces 3 products A, B, C, and following information related to such product as follows: sales, variable cost, contribution, all of them are positive, and fixed cost 17, 18, fixed cost 20. And the profit or loss, yeah, A produce profit, B produce loss, and C produce profit. Here, the B, right? B is making loss. So they are considering close down the product B. Close down product B. Since receiving loss by the product B, the company decided to drop the production of it. The company absorbed the overhead costs each product on the basis of direct labor hours, right? So here, advise the company respect of dropping product B. What is your decision? What is your advice? What is your advice? For the question number 1, if the management decided to close down, so what is your decision? You support of close down of B? Imran, what is your advice? Anyone else? What is your advice? Anyone else, please? It's a critical question, please. What is your right or wrong? No matter.
Yes.
So you support for the decision of close down closed
Yes.
on product B. Yes, right.
B.
B. So they are going to close down. No, right? Here, what does it mean, the fixed cost? When you decide to close down the B, can you avoid this 18,000? So you purchase the machine for 18,000. When you stop the production of B, there will be a cost of 18,000 incurred. So if you stop the production B, you will be 18,000 loss. Why is that? Even though the production is equal to 0, there will be a cost, right? Unavoidable cost. 18,000 is incurred. When you produce and sell in the market, yes, sales 40, variable cost 20, then you can earn 15,000 contribution. So when you continuously continue the production, right, you can reduce the loss of 18,000 into 3,000. You can reduce this 18,000 by 15,000. So now tell me, is it advisable to stop B? Is it advisable?
No.
No. If you stop production, you have to encounter a profit, a loss of 18,000 per unit. And if you continue, you can reduce the cost by 15,000, and the specific cost could be only 3,000, right? So that is case B, right? Now they give you an additional information. If an extra cost of 5,000 will be incurred the production B, right? Is there any change in your decision, right? Here, if you want to continue the product B, you encounter a fixed cost of extra 5,000. Extra 5,000 fixed cost you have to encounter. This time, do you accept to close or continue the product B? Now its fixed cost become 23,000. Do you accept to continue or discontinue operation?
For the same scenario, we have to accept. That means
Accept.
we have to continue the production. Yeah.
Yeah, continue production because it give us 15,000 and the additional cost will be 8,000. Therefore, right? So still you can make positive contribution. Can make positive contribution, right? 15,000 plus 15,000 minus 8,000, then you will have 7,000 loss. So sorry, by 8,000 loss. You see, sales 40,000 from the B, product B. This is number 1. This is number 2. Sales value 40 and the variable cost is 25. Extra fixed cost is 5. Extra cost, right? Then altogether 30,000. 30,000. Then you can have 10,000. 10,000 what? Contribution. Positive contribution. Earlier you make 15,000 contribution. Earlier you made 15,000 contribution here. So therefore, you always have to look at the contribution, right? Here 50,000 contribution, and additional fixed cost is a relevant one. So therefore, right, you may right 18,000 become 8,000, 10,000, so 18,000 fixed cost become 23,000. Yeah, 23,000. Still, you can get profit. Right. Now the third question. Right. If you have any problem, please let me know. If you are not clear. Right. The third one. In addition to the information 2, right, this one, 2, consider the company is able to receive a sale income 50,000. Company able to receive a sales in 50,000 by producing Y, right? Already they are talking about A, B, C, and considering close down of B. But here, by using the same machine, right, they can make sale of 50,000 income by producing Y when dropping the product B. When dropping product B by using such resources to produce Y. Right? If you close down X, so close down B, you can start producing Y. It's expected to incur variable cost of 30,000, extra cost 60,000 for production Y. So what is your decision? Now you have an opportunity cost. Opportunity cost. Either you continue B or Y. If you decide to produce B, continue B, then you have to lose the income by income, right? You lose income. Why? First, we have to find out the opportunity cost. Opportunity cost. How we find the opportunity cost? Yeah, we can sell it. We can sell it for 50,000. Variable cost of Y 30,000. And very importantly, if you decided to produce Y instead of B, you have to purchase a machine parts for 6,000. When you choose to produce Y, you may incur 36,000 rupees, and selling price is 50, and opportunity cost, incremental cost 36, and yeah, there will be you have to lose 14,000 profit from Y. So this is opportunity cost. You have to consider. You have to consider as an opportunity cost. You see that third question, sales 40, variable cost 25, additional fixed cost 5, and the opportunity cost 14. Then total cost equal 44,000, and it give you a negative contribution of 4,000. So therefore, close down, right? Better to close down product B. Close down product B, right? Close. And you continue A, C, and Z. A, Z, and Z. Clear? Okay. And this is next right. Next, then it's this question is about second scenario. They have to go for the shift, work shift. The current capacity is not sufficient. Current capacity is not sufficient, so therefore they have to decide whether go for a shift working or not. Let's see. So read. I give you 1 minute. Please read this. Read out this question. So in assignment, you have no services. So we drop that one. So here we are talking about this one. Extra shift decision. Extra fixed decision. Here the comparison would made with the relevant cost of working of extra shift. Extra shift. Extra shift. Here the relevant cost are incremental cost includes variable cost and extra fixed cost plus additional cost. I read this question once. Read this question once. Okay. Gunaradna company produce product B by working only a single shift. The relevant information for the shift first half of 20 as follows. Here sales 10,000 units. So therefore, 10,000 units mean right. The cost per unit is 36. Sorry, sales price 36 would be because 10,000 units. Direct material cost 12. Direct labor 10. Variable overhead 20. All are variable costs. So therefore, contribution 120 per unit contribution could be 12. Fixed cost 20,000 per hour, and the profit could be 100,000. A demand for additional unit. A demand for additional unit of rupees 6,500 at present price is available. Right? It's available, and it's expected to work an extra shift for this purpose. However, implementing this extra shift, the extra fixed cost of 8,000. That extra fixed cost will be 8,000 to be incurred. Similarly, it's expected to incur cost of 150% of labor cost. Earlier, the labor cost per unit is 10. Right? Now it 20% increase. 20% increase. If already 100%, now it's become 120%. Alright, 20% for the production unit, the first shift. But it could be obtained 5% discount on purchase of extra raw material. Since incurred quantity of units is purchased. So since they are having right bulk order, they can reduce the material cost by 5%. So if if the material earlier 100%, 100 rupees, 5% discount or 5% discount, it could be 95, which is 90%, 99%. You're required to decide whether the extra shift should be implemented or not. Right. So when you incur the extra shift, right, extra shift, labor cost, you have to pay labor cost, but you purchase bulk order and you can reduce. So one side increase the cost, another side you can have some sort of saving. This time, do you accept or not? Right, sales volume, right, sales volume. So he gets 6,500 units. They can produce extra demand. To satisfy this extra demand of 6,500, the selling price per unit 36. How we got 36 here? 36 rupees per unit. 36. Unit 36. It's a unit of 6,500. Yeah. Sales 6,500 into 36. So you can earn 234,000. Variable cost. Variable cost for 6,500, right? Here, that's an issue. Labor cost will be increased by 120%. And the material cost will be go down by 5%. So therefore 95. Now we have to find out the revised variable cost. Direct material cost earlier is 12 rupees. So direct material 12 rupees per unit. Then 5% discount, so it's equal to 95%. So it's equal to 11.4. Direct labor cost, earlier it is 10 rupees per unit. Now they have increased by 20%, and it could be 12. And the raw material, so it's not raw material actually, it is variable overhead cost. Variable or no changes in variable overhead, no changes. So 20,000 for 20,000 rupees for 10,000 units. For each unit could be 2 rupees variable cost. Variable cost could be 2 rupees. Variable cost could be 2 rupees. So therefore 40, 25. So 25 rupees and 40 cents. 40 cents. So that could be the variable cost. Variable cost 2540 into 6,500. You will get 165, 100. So to run, right? So they have to incur additional extra cost is 8,000. So therefore, our total cost could be 173,100. And sales this value, and total cost is this. Then contribution could be extra profit could be 60,900. So therefore they can accept the shift. Accordingly, the extra shift should be implemented, right? So now we can finish the short-term decisions. Right? Any questions? Any question on this? From the short-term decision, we consider limiting factor, make or buy decision, and a combination of make or buy decision, and accept this special order, right? And continue or discontinue operation, and finally we talk about accept or reject extra shift decisions. So these are the short term, right? Instantly we take. So next session, it will be focusing on long-term decisions. Long-term decision. Here we will talk about the long-term decision. Right, long-term financial decision process relating to capital investment decisions by comparing two projects using tax, right, income tax NPV and IRR with a justified hurdle rate at minimum required rate of return. And we have to include inflation, corporate tax, working capital, in and out, and so on. And also here to talk about depreciation, tax shield, terminal value, include the scenario, and one sensitivity analysis. Provide broad ready recommendation explaining how assumption will be united. Right. So this is the third section of C2, C3, right? C3, and the next two classes we will focus on task 2, that is talk about ratio analysis and financial statement analysis. So after that we can close down, right? Today we have to complete first part of NPV and the basic foundation of investment appraisal and investment appraisal and payback, a account rate of return, and NPV and IRR. So basic. In the next class, I will teach you how to calculate, how to incorporate inflation, incorporate income tax, and so on. After that, we will discuss ratio analysis and the ratio analysis and the financial performance, financial statement analysis. So this is common question. So it's linked with your introduction strategy. But shall we have a break and shall we continue at 10:30? Shall we meet at 10:30? Okay. Okay. Thank you. Okay. Right, shall we start? Shall we resume the session? Okay. Right. Meanwhile, I will share the book chapter so that it will guide you to write your assessment. There are a lot of examples, case studies, so that you can take some of the parts and you can use for your assessment. So 40 MB, so I will share it later. Yes. Okay, let's move on long-term decision making. So why we call it a long-term decision making? What are those? So we talk about earlier CVP analysis and limited factor analysis. So what does it mean? While we do the production, we already invested somewhere, already invested to produce product A, B, C, and how many units to be produced, and what is the break-even point, whether right. So that's that kind of decisions we have taken, especially when there's a limiting factor. So whether choose or not, and already we have product A, B, C, and whether we continue or discontinue or accept or reject a special order. So all these things are right day by day. These are operational decisions. Operational decisions day by day. As a marketing manager or production manager, finance manager, you have to take, recommend or not recommend the decision, right, on daily basis. But that's why we call them as a short term, right? Short term decisions. Now we are focusing on the long term decisions, right? Long term decision, long term decision. Long term decision. So what do you mean by long term decision? Yeah, when you look at your any balance sheet, here you can find equity, and we can find the long term debt and short term non-current current liabilities. Current liabilities here, non-current liabilities, and here non-current assets and current assets. Right. Non-current assets, you may find property, plant and equipment, land and building, and so on. Right. Especially in the property, plant and equipment, you can see property, especially property, plant, right? Plant mean a large machines, equipments, right? The long term, right? Say a machine to cement, right? Cement factory, there's a machine, right? Porcelain, there's a machine, right? So it's a long term, right? It can be used for long term. Once you take decisions, right? For example, to buy a particular machine, cement producing machine factory, right? So it's a one-time decision. So once you take this decision, it lasts for long periods, 5 years, 10 years, sometime 50 years. You can't go back to the decision. Once you make inappropriate decision at this moment, and right, you can't reverse back. Not like short-term decisions, break-even point, not like this. Whether the company going to start a new business line like solar efficient, solar power plant, wine power plant, or they are going to purchase a tea estate, rubber estate, or they are going to produce a bicycle manufacturing company, car manufacturing company. Once they decided and started, they can't reverse back. So that's why it's called non-current assets. It should provide, it should sufficient to provide return on investment, return on investment. Equity shareholders invest their money in the company, and they also take the money from the bank and third parties. Equity is an internal fund and external fund. So this fund allocated for the non-current assets, property, plant, equipment, especially. So that should provide sufficient return on their investment. Right? So how do we make investment decisions, long-term investment decision? It is not occurs frequently in an organization, companies, right? It may occurs every 5 years, 3 years, right, in that time frame. So with that note, we will discuss what are things we have. So introduction to investment appraisal. Investment appraisal mean whether we are going to invest in a particular new business, solar, go for a solar, or wind, or they're going to buy a tea estate, or invest on rubber estate, like that. So that is called capital investment appraisal. Appraisal means assessment, whether it's viable investment or not. Capital investment appraisal payback periods. So there are methods to appraise which one is more profitable out of this. Number one, everybody knows payback period, accounting rate of return method, and what are the principle of discounted cash flow, right? So this is very important, discounted cash flow. Annuities and perpetuities, working capital and profit, and very important, net present value and net present value appraisal, and plus IRR, internal rate of return, and what are the things in NPV, and what are the factors. So this is part one. In assessment, they are talking about working capital, right? Working capital and things. Here, inflation, with inflation, taxation, right? We will cover these two things because of right, in assessment that there are things have to be incorporated. So therefore, we'll discuss. This is advanced one. This is corporate level, right? Corporate level of CA examination. This is business level. Right? Capital investment appraisal. What does it mean? So I have already discussed. When capital investment is made by an organization, it is normally for a substantial amount, right? A big amount to buy a tea estate, to buy a rubber estate, to establish a cement factory, paper factory. It will take a substantial amount of investment, and the size, right? Size of the organization. It will decide the size of the organization. Therefore, an appraisal should be completed to enable the business to make decision as to whether the investment in a particular project. The organization need to ensure that it is using the resource available to the business in order to obtain maximum benefit from them. So we will now look at the different method that senior management might use to enable the decision to invest or not to make. Capital investment appraisal. So the basic method is payback method. Payback means once you make investment today, how long it takes to recover your investment. How long it takes to recover your investment back to you. The payback period is a time that is required for the cash flows from a capital investment to equal. For example, if you invest in solar power plant, right, in your home, rooftop solar. So if you want to establish 10 kilowatts, say you invest 20 million. If you invest 20 million, how long it takes to recover this 2 million? So it may be 3 years or 5 years, like that. So how long you have to wait to recover your capital? So that is payback. The payback method is the time that is required for a total of the cash flows of the capital investment project to equal the total amount of the cash outflow, cash inflow and cash outflow. So in the solar panel investment, right, you invest, the money is go from your pocket, that is money outflow. Every month you are receiving some sort of revenue in cash, that is cash inflow, money come into your pocket. Before the payback period can be calculated, management must have the detail of the following: the initial cash flow, initial cash outflow for the project under the consideration, an estimate of any future cash inflows or savings, sometimes cost saving. Let us see one example. Ruby LLC is considering a new project which will be require an initial investment of 60 million, right? It will require 60 million. The estimated profit before depreciation, we will forget the depreciation now, follows, right? The first year, by investing 60 million, the first year you can take 20 million, second year 30 million, third year you get 40, 50, 60 million, right? The payback period is calculated by considering the cumulative estimated profit before depreciation, right? You should not consider any depreciation. Your investment is 60 million. Investment is 60 million, right? How long it takes to recover your 60 million? So that's a systematic format technique to find out this. So look at the first year. First year, your cash flow 20. Then cumulative cash flow, right? 20, right? It's starting year 20. The second year, you will receive 30. Earlier you take 20, now 30, altogether 50. And altogether 50, the third year you get 40, then 90, right? At this point, your 60 million recovered or not? In 3 years, your 60 million recovered, right? You need 60 million, but end of third year, it give you 90 million. Can you tell me exactly how long it takes? How long it takes to recover your money, your investment? Here, out of 60 million, you raise 50 million in year 1 and year 2, right? Definitely you need to wait 2 years. The third year, you receive 40,000, but to achieve the 60 million, how much you need at the end of second year? To achieve 60 million, how much you need? How much do you need? You earn up to end of 2 years, you earn only 50,000, but you need to recover 60 million. Then how much amount of money you want to get further?
10.
How much? 10 million. Yes, you need 10 million, right? 10 million, but you will get 40,000. So therefore, this 40,000 distributed for 12 months, but we need only 10 million over 40. right? This year we receive 40, right? 40 into 12 months. 12 months. Then what we do? 1/4. Yeah. Um, 3 months, right? On within 3 months, first 3 months you get here. In 3 months you can get. Then you have to wait to recover your 60 million. 2 years plus 3 months. Two years and 3 months. If on other hand, if the cash flows are received end of the period, if we assume the cash 40,000 cash will be received at end of the third year lump sum, then definitely you have to wait for 3 years. But earlier, 2 years, 3 months, we assume that the cash received eventually, and every month you may receive an equal amount of money in a particular period. In that assumption, we consider 12 months. But if it's the case you receive entire money at end of each year, then you have to definitely wait for 3 years. Clear? Okay. Using the payback period to appraise the capital investment projects, there are two ways in which payback period can be used to appraise the projects. If two or more mutual exclusive, what do you mean by mutually exclusive project? Mutually exclusive project mean what? Mutually exclusive. Mutually exclusive mean, you know, a tie. When you throw a tie like this, when you throw this tie, and you may get, there are 6 outcomes. There are 6 outcomes from 1 to 3, 4, 5, 6. There are 6 outcomes. Right. At a time, you get out of the 6 only one outcome. Only one outcome. So we can't get 1 plus 3. We can't take 1, 2, 3, 4 at a time. Here, that is called mutually exclusive. If one happens, we can't have another balance the rest of the outcomes. So that is mutually exclusive. Most of the case, companies appraise the project with the different options. Say, if the company wanted to invest the money in the energy business, either they can go for wind energy, right? Either they can choose wind, either you can go for wind energy or solar energy or coal or right some sort of atomic energy, right? So there's an option. So if they choose option 1, they can't choose this because of the constraint, because of budget constraint, budget constraint, right? For some electronic companies, they option 1, they produce mobile phone. Option 2, laptop or devices. If they choose mobile development, they can't use this. So this is called mutually exclusive project. But some cases, they can prioritize project A, project B, C, D, like that. So they have a certain amount of money, right? So based on the ranging, they can choose A, B, and D, or they can choose B, C, D, or some case A only, based on the budget constraint. So those are not mutually exclusive. Those are not mutually exclusive. That's the term word here. If two or more mutually exclusive projects are under consideration, the usual decision is to accept the project with shortest payback period. If you have multiple options, the best one is any investment that give you your money back within a short period of time. So that is the preferable one. If the management of a company have payback period limit, say for example, the investor says, I need my money back within 3 years, or I want to back my money back in 5 years. If any project exceeds 5 years, no project can be accepted. Right? That's also may happen. Suppose example 2.4 project website payback. Suppose Ruby Limited has a payback period limit of 2 years, right? Any project exceeds the payback 2 years, they cannot be considered. And is considering investing in one of the following projects, both of which require initial investment of 4 million. Right? A also need 4 million, B also need 4 million. When you look at the cash flow, so lifetime of the project is 5 years. This is cash flow pattern of A and this is cash flow pattern of B. Calculate payback period of the two projects and state which is the most acceptable project. Can you calculate it quickly? Payback is very easy. Can you calculate quickly, easy? How long project A takes to give you payback and project B? Please calculate how long it takes to recover 4 million. Quickly, please. What's the payback period of A? It is easily, quickly we can find. No need paper or pencil or paper. How long? A payback period. Imran, how long A takes project A? How long it takes to give back your 4 million? Imran, are you there?
Yes, sir.
Yeah, how long it takes?
Seems same period both.
No. Project A, how long it takes? To give your money back. Payback period A, how long it takes? Any others? Any other volunteers? How long it takes? How long it takes? How long it takes to recover this 4 million? Here, the first year, it give you 100, cumulative 1 million. Second year, it give you 2, so therefore you get 3 million. The fourth year, you will get 4 million, right? So it takes how many years? How many years it takes? 3 years. It takes 3 years to recover your investment. Look at project B. First year, it give you 2 million. Second year, 1.8, so therefore 3.8 million. The third year, it give you 5 million, 1.2. So therefore, 5 million. Right, so payback period here, they need only 2 million, 0.2. 0.2. Yeah, 0.2 over 100 and 1.2. 1.2. Then how much into 12 months? Right? In this case, and they clearly state that Ruby LLC has payback period is limit. It has limit of 2 years. Any project give payback within 2 years, which is acceptable. Any project goes beyond 2 years cannot be rejected, cannot be accepted. So that is the scenario here, limitation here. Here, when you look at here, cash flow project A, right, 400,000 can be received in 3 years. So therefore, the payback period is 3 years. And project B, cash flow here, 3, 8, and 5, right? So it covers 2.8 within 2 years, and additionally they get a big amount of money. Right? We need only right 2 years. We need only 20 million. 20 million. Actually, not a million, right? It should be 2 million, right? 2 million, and out of 1.2 million, right? Into 12 months, it requires only 2 years and 2 months. Requires only 2 years, 2 months. But the thing is, their limit 2 years of payback period. Since Ruby LLC has a payback period limit of 2 years, neither project should not be invested in. The both payback periods are greater than 2 years. If, however, Ruby LLC did not have any payback limit, it was 3 years or longer, it should be invested in project B, right? So if there is no limit, they can give preference for project B. It has the shorter payback period than the two projects, right? When we compare this project A, project B will give you a shorter period. Here, project A requires 3 years, project B requires 2 years plus 2 months. So therefore, B give you the payback within short period than A. So therefore, we can go for B. So this is an exercise you can do by yourself. And there's a small explanation. What does payback mean? The payback for investment is measure of how long
Excuse me.
it is.
Yeah. What we discussed about that 44 million. This thing.
Yeah.
The figures are right.
Here the figures. These figures are
because,
wrong.
Yeah. Huh?
It should be 2 million, 0.2 million.
Yeah, at the same time, the question also wrong, no? The 4 million, because we
No, no.
try to calculate 4 million recovery time, right?
Wait a minute. I will confirm it. So this is actually how much? Yeah, this is 200 million. No, it is 200 million. The question also some. Oh, yeah, very good. It should be 400 million. Yes, it should be not 4 million. So this is 1 billion. No, this is 100 million, 200 million, 100 million. Not actually. So million has 6 zeros, right? 6 zeros. Here, what's the value? This is 0.1 million actually. This is 100,000. 100,000. 1, 2, 3. 100 million. 100 million. 200 million. 100 million. 150 million. 150 million. So it should be 400 million. If we change this
Yes.
one, it's fine.
Yes,
Yeah,
400
it would
million.
be
Then okay.
400 million. Okay, 400 million. So you're confused because of the zeros, no? Okay. Okay, good. Good question. Yes. It should be 400 million. Then, yeah, the rest of the things are fine. Not rest of the things. Actually, this also issue, right? 2 million also issue. Not this is fine, no? 120 million is fine. Yes, this is fine. The answer is fine. The question, there are confusions. Yes, it should be 400 million. So we have to correct only, yeah. Okay, good question. Thank you very much. Yeah, the payback for investment is measure of how long it will take to recover investment. You know, if it has a capital, payback means when you money for long, when you pay back my money, right? Pay the cash flow, the period is very important. Similarly, payback may be a way of avoiding investments in a projects where expected cash flows are difficult to estimate reliably, especially more than few years in the future. Right? If somebody says this project give you your money back within 2 years, 3 years, they may accept the project most probably. But if people think it takes about government changes, cultural issues, environmental issues, so therefore people always prefer investment. Short investment may be long, but they need money back within very short period of time. 20% income, 20%, right? 22, 40% is a reasonable return. 20% return means you can recover your money within 5 years, right? 50% return on investment mean you can recover your money back within 2 years. Right? This percentage matter. However, payback does not measure the value of investment. Right? Some investments during the first year, 1 year, 2, during that period, it gives you a small amount of cash flow. But later, right, market grows exponentially and it attract many customers. It produces a lot of output. Then it gives a big amount of money after 4 or 5 years. So payback method cannot consider that, right? It's because right? There are some lot of there are some of the limitations of payback period. It ignores cash flows and return after the payback period. Payback is often used. Paybacks are often used as initial start of an appraising project. However, a project should not be evaluated on the basis of payback alone, right? So, using payback period method alone, that cannot be acceptable due to some its own limitations. If a project passes the project test, the payback test, that is, it has a payback period that is less than a payback period limit, as I told you 3 years example earlier. Project appraisal techniques such as, all right, we need, sorry, the company, then it should be evaluated further with most sophisticated project appraisal techniques such as NPV and IR. So these two are most commonly used in many projects, many investment appraisal projects. Let's go through another method called accounting rate of return. Some people call it as a return on investment. Some people call it them as a return on capital employed, right? So they have a different name based on the context. The accounting rate of return method, also called return on capital employed, ROCE method, or the return on investment, ROI method of the appraising project, is used to estimate the accounting rate of return that the project should yield. So this is in percentage. It's given to 20 or 40 or 60% like that. If it exceeds the target rate return, the project will be undertaken. Say, for example, minimum we expect 20% return. If give you 30% or 40%, right, you can choose that investment because it exceeds your minimum expectation. But if the project give you 10%, 18%, then definitely you will reject. But also this method as well having some sort of limitations. The most widely used formula is this accounting rate of return equal average annual profit from investment. This is average, very important. Average annual profit. Average annual profit, investment, average investment. Unfortunately, there are several different definitions of ARR, including estimate total profit. Some people take total profit, estimate total investment. Some other people use estimate average profit, estimate initial investment. So there are different. The top here, top numerator and denominator both are average in the first equation. The second equation, they are taking all the values are absolute value, right? And here, the numerator, they are taking average, but here the denominator, they are getting the absolute value. Right, so there are different methods, but anyhow, this method is most commonly used. Let's see this example. Please read this example and have an idea on this. Right, a company has a target accounting rate of return, right? They are expecting minimum 20%. Using first definition, they go right earlier, both are average, and is now considering the following project. Initial investment is 80 million, life 4 years. The first year 20 million, 25 million, 35 million, 25 million throughout these 4 years. The capital asset would be depreciated by 25% of its cost each year and will have a no residual value. Right here, we are talking about accounting profit. Accounting, not from cash flow, not cash flow. Right? Accounting profit. Yeah, this is profit before depreciation. So accounting profit is always cash flow minus depreciation. So therefore, to find out the profit, we have to deduct depreciation each year. Then how do we calculate depreciation? Right. So this investment is 80 and it should be divided by 4. Therefore, 20 million each year depreciation. 20 million, right? Since it has no residual value. It will have no residual value. So here, 20 million deduct 20 million, 20 million, 20 million. The first year, 0 profit. And second year, 5 million. Third year, 15 million. Fourth year, 5 million. Right? So this is the profit. So total profit we have divided by 4 years. Then we will get accounting return. Accounting return. And the initial average investment here, 80 million. This is an initial investment, no? So initial investment and investment at the year end. So residual value. Here residual value is 0. So we take 2 values and divide by 2. So that is the average investment. Based on that, we will calculate the accounting rate of return. Right? Depreciation here, profit after depreciation, 0, 5, 15, 5. So this is the profit after depreciation. And mid-year book value, right? Mid-year book value, so 80 million, it's 80 million. 80 million every year depreciate by 20 million. And the book value at end of the first year, it should be 60 million. But here they take a mid-year. Mid-year mean on 6 months. The 6 month of the first year, the depreciation could be only 10 million. 10 million. Therefore, the residual value is, the book value could be 70 million, mid-year book value. And the second, 1.5 years. After 1.5 years, right, 30 million and 80 minus 30 equal 50. So these are the market value. So look at year one. What is the accounting rate of return? So in the year one, average investment is 70, a huge depreciation. So therefore, no return. So the accounting rate of return is 0. Accounting rate of return is 0. Second year, average investment, the mid-year, 50,000, and the profit 5,000, and then the accounting rate is 10 million, 10%. Third year, 30,000, 15, you see 50. And even though they are getting less amount of profit, but the investment is after the long period, right? 50, right? 50%. This is how they calculate accounting rate of return. But this is not the absolute value, right? It's incremental, right? So based on the time. But here, the above, the test shows the accounting rate of return is low in the early stages of the project, particularly because of the low profit in the year one. But mainly because of the NBV, right? Net book value, right? Net book value, which means cost minus any depreciation equal book value of the asset is much higher early on its life. The project does not achieve the target rate of 20 million in the first 2 years, but exceed 3rd, 3rd, and 4th year. So should be undertake, right? let's see the overall return, accounting rate of return. When the annual rate of return from previous project varies from year to year, right? The ARR is differ year to year. It makes sense to take an overall average rate of return. Average rate of return. Okay. In this case, we should take a total profit before depreciation 105, before deducting depreciation. Total profit after depreciation 25, right? So 105 minus 80, right? 80 equal 25 million. Average annual profit after depreciation, right? So this 25,000 divided by total 4 years. So every year it gives us 6,250, 4 years project. The original cost of investment 80, and the average net book value of the project 80,000 minus 0 divided by 2 average. So therefore we take 4. So therefore we have to take these two values. 6,250 divided by this 40,000. Then the project will, right? So when we look at the percentage, it's look 15.625. 15.625. So the target 20%, but it gives you 15.625. Therefore reject, right? Your yield reject. So this is we calculate the ARR against one criteria and we choose. The second case, the ARR, accounting rate of return, and the comparison of mutually exclusive project. As I told you earlier, if we choose one, we have to drop all other investment options. So that is, so in this case, you have to choose highest accounting rate of return. The ARR method of capital budget, capital investment appraisal, can also be used to compare two or more projects. Compare two or more projects which are mutually exclusive. The project with highest ARR, you see the highest ARR would be selected, provided that the expected average annual return, accounting rate of return, is higher than the company's target, right? Accounting rate of return. Let's see, read this question once. Give you 1 minute, please read. Right. Here, the arrow wants to buy a new item of equipment, right? Means 1. 2 models of equipments are available. One is slightly higher capacity. So when you look at this machine Y, the higher capacity and reliability, you see the cash flows look smooth. But when you look at this machine, first 2 years it give you a highest return, and then it give you what it goes down. So project Y, it's high capacity and greater reliability than other. The expected cost and profit of the item as follows. So to buy this equipment, next we have to invest just 80,000. Use and throw concept. And why you have to spend 150,000. So it can give you a decent return up to 5 years. ARR is measured as the average annual profit after depreciation. That is very important. ARR measured as average divided by the. So here state whether the equipment Y should be selected if the company target ARR as 30. So there are two conditions. First, we have to compare X versus Y. Even when we in our comparison AOB may be selected, XOY may be selected, and then we have to compare the target. At least it give us 30% accounting rate of return. Right, so very careful here. You have to the expected cost and profit. So it's a cost and profit. So the average profit after tax depreciation. Let's see the answer. The correct answer is that X should be selected, and so on the 7 spots. Right. Let's see. To buy, right? The total profit life of the component. Profit before depreciation 160, right? And after depreciation 80, because here investment is 80. Investment is 80 for X, but it gives us 160 million throughout the period. You see, when you total is 50, 100, and 150, right? It gives you 160,000, right? This is total cash flow, not cash flow, total, yes, total profit before depreciation. And here 50, 50, 100, 180, 280,000 of this profit. Here investment is 80, so we deduct 160 minus 80, it will give us 80,000, and 280 minus 150, 130, right? So the profit after tax is 130, this is 80. That's what here, 80, 130. The average annual profit after depreciation, so it should be divided by 5 years period, right? Because the lifetime of the project is 5. So therefore, average profit a year 16,000. Average profit could be 26,000 per year. Right? Average investment, so 80,000, no, 80,000 average 40, 150,000 average 25. So when we look at the ARR, 16 minus 40, so 16 divided by 40 equal 40%, and 26 divided by 75, it's equal 34. Right. So our minimum accounting rate of return is 30%. Both projects would earn a return in excess of 30%, but since item X would earn a bigger ARR, it would be preferred item than Y, even though profit from Y would be higher by an average of 10,000 per year. Right? Even though the machine Y give you a decent return, reliable return, but it requires a big amount of money, almost double of investment. So in this time, you can buy a machine and use and throw. Use and throw concept you can follow. Rather than buying Y, you can invest on buying X. That is ideal solution. Is it clear? Is it clear? Right. Then we go to the drawbacks and advantages of AR method of the project appraisal. Right. So there are pros and cons all the methods. So normally in the company in real world practices, accounting manager use different techniques, and they're not solely on AR method or ARR or payback period method, right? So even though there are a lot of things, ARR method has a serious drawback that does not take into account of the timing of the profit. So like in the payback, it does give clearly signals how long it takes to recover your investment, but in the ARR, you can't find it. Whenever capital is invested in the project, money is tied up until the project begins to earn the project profit, which pay back the investment. Money tie up in one project cannot be invested anywhere else until the profit comes in. Management should be aware of the benefit of early repayment from investment, which will provide the money for other investment. When you look at why do people prefer on payback method? If your money invested in a project come back quickly, you can use that money for another project. You start the project that is going on. Once you recover your investment, right, the project still exists, then it will give you, start giving money. Always it's giving money, cash cow, it give you money. Then your money come back quickly and you can start another cash cow, then another cash cow, right? It's a right. So that's why people prefer on what payback method. There are a number of other disadvantages of accounting rate of return. It is based on accounting profit. Accounting profit, you know, the depreciation is a non-case item. But to find out the profit in accounting terms, you have to consider the depreciation, which are subject to a number of different accounting treatment, right? Depreciation, some may argue depreciation 20%, some may argue 10%, some may argue 50, right, 24. So different ratios, right? So there are a lot of weaknesses. There are a lot of discrimination among the accounting treatments. And it's a relative measure. Relative measure mean, right? So there are two, x over y. So this is relative measure, x measured related to y. Here, accounting profit related to average investments. So this is a relative measure. Impact of one will impact on other. It's a relative measure rather than the absolute measure, and hence take no account of size of the investment, right? So it's give size. So we can buy a mango for 20 rupees, and you can buy it for, you can sell it for 40 rupees, or you can sell it for 50 rupees. Then your profit will be 30. Here, what is your investment return, right? It's almost 1.5, 150% return. But you just investment is 20,000 or 50,000, right? Mango business. But when you involve in car business or vehicle business, you can buy at 50 million and you can sell it for 60 million, right? Even though the profit margin is very less, right? 10 million profit, and the profit, it give you a huge cash flow. That's why the mango business and car business are not equal. The mango business will give you high return, but not big cash flows. But car business will give you less return, but it will give you a huge cash flow. So therefore, accounting rate of return, always they are looking at the rate, not the cash value, real profit. It takes no account of length of the project, right? It doesn't consider how many years. Like the payback method, it ignores the time value of money. Time value of money concept is very important. I will teach you in a couple of minutes. There are, however, advantages of accounting rate of return. It's quick and simple to calculate, and it involves familiar concept of percentage return. Accounting profit can be easily calculated from this financial statement. Right? You don't want to estimate the cash flows like earlier by looking at the financial statement, profit loss account. You can easily track. You can find it easily, and it's easy to calculate. It's look at the entire project life. A manager and investors are accustomed to think in terms of profit, and so an appraisal method maybe employs a profit therefore more easily. Normally in the companies, the bonus are decided based on their performance. Performance are measured not based on the profit, which are based on the rate of return. Rate of return. The mango business will give you a higher performance, but car business will give you a high profit, but in terms of performance, it will show a small performance. So therefore, managers may prefer that. Right. What is discounted cash flow? What do you mean by time value of money? Have you studied earlier about time value of money? Have you studied time value of money concept in your previous studies? Have you studied? Have you studied time value of money concept? Present value, future value, annuity. Have you studied? If you studied, I can directly move to the formula. Otherwise, I have to explain little at least. Have you studied? Yes or no?
Please explain us.
Studied?
Can't remember. Can you explain?
Yeah, please explain.
Okay. The time value of money concept is right. Right. We have 10,000 in your pocket, right? You prefer you receive 10,000 today, right? Today, and compare this. You can give 1,500 in 5 years. 5 years. So there are two options: option A, option B. Option 1, you can get 10,000 today, or wait 5 years and get 1,500 after 5 years. Which option you prefer? A or B? One person come and give you two options. First option, you can get 10,000 immediately, or 1,500 after 5 years. Which option you prefer? Option A or B? Option A or B?
Is it 1,005 or 1,005K?
1,500. This is 10K. Sorry. 1.5. 10, 15, right? 10,000 or 15,000. 10,000 or 15,000. 10,000 A, 15,000 B. What's your option? What's your preference?
5,000 more, but we have to wait 5 years. So better to go for A.
Yes. So why is that? So for 10,000 K, right? 10 for for example 10,000, right? You have 10,000. You can buy something, right? A basket of a basket. You can buy a full for 10,000. After 5 years, do you able to buy the same amount of item for using this 10,000? Can you buy after 5 years using 10,000? Can you buy the same item for same amount? No, like this. You have to You have to pay 10,000 for this amount, this level of output. Even though if you get 15,000 on that period, you can buy only this. And so due to the inflation and other things, the value of money is go down. Value of money is go down always. Most 99% chance. We are not in China, we are not in Taiwan, we are not in Hong Kong. In such countries, price go down. Inflation is negative, 0.03, 0.01. Right? They have negative inflation. China, no price increases in China. Right? Here we have 7%, 8% inflation. Sometimes during the financial crisis, we had reported 70% reported inflation, but actually not true. According to my estimate, it goes to 200 to 300% inflation. Like Turkey, Venezuela, Zimbabwe, right? In Zimbabwe, you can see 1 trillion not, right? So because of the inflation, right? Here, due to the inflation, the value of the money is go down. So it's called the value of the monies are depreciated. In accounting, we call them as a discounting, right? Discounting of future value of the money, right? Say you are going to receive 15,000. You are receiving 15,000 in 5 years. So this is future value. This is future value, right? This 15,000. This 15,000 is future value. 10,000 is a present value. Why we call it a present value? You can receive 10,000 exactly today, right? That is present value. But here, why we call this 50,000 as a future value? You are going to get this 15,000 after 5 years in future. You are going to receive this money in future. That's called future value, right? We assume, right? So forget about you are living in China, right? You are living in China, no inflation, but banks give you 10% interest. 10% interest. 10% interest for your investment. If you invest 10,000 rupees, today, how much you will receive in second year? How much you will receive in 10 years? Sorry, in second year at 10% interest. How do you calculate? Assume no inflation. If you deposit 10,000, the bank tell you we provide 10% interest. Then how much you will receive in second year? So not second year, first year, right? First year. First year. How much you will receive?
110.
Very good. 110. Right? 110. Here, how we get? If we invest 1 rupees, right, and you will get 0.1. 0.1. If you invest 1, you will get 0.1. And number of period is 1. Number of period 1 year. So therefore 1.1. So 1 year, no, so no issue. So you have 10,000. So when you solve this, you can get 11,000. And you will get 11,000. Am I right? If you invest 10,000 in 1 year, you will get only. So wait, give a minute. Am I right? Say, if we invest 100 rupees at 10% interest rate, 10% interest rate, how much you will get at the end of 1 year?
110.
110, right? 110. Here, the 100 is P. 100 is principal amount. R is rate of return. R of rate of return. So how we calculate? The formula is 1 plus R. If you invest in 1 year, you put 1. If you invest in 2 years, you put 2. Right? N is number of period. R is rate of return. This is 1, normal 1, and we can put the principal amount. Right. This 110 will get in 1 year. When you will get this 110? When you will get 110?
End of the year.
End of the year. Is a present or future?
Future.
Future. So this is called future value. To get this 110,000, you have to invest how much today? Today, 100 rupees. This 100 rupees present value or future value?
Present value.
Present value. This is the present value. 100 rupees present value and 110 rupees is the future value. Right. We arrive this future value, right, based on this formula. Right. Future value equal 1 plus R, 1 plus R, the P, the N. Let's assume, let us P equal 100 rupees 1, but it's normally 1. 1 plus what's the rate of return? Rate bank return 10%. That means 0.1. 0.1. And how long you are going to invest it? For 1 year. N equal 1. Then it will be 100 into 1.1 with the power 1. Then it's equal to 110. 110. Right. Can you tell me if they invest for 2 years, how much you will get? How much you will get?
121.
121. 121. So what we do is, right, what we do today, 100 present value, 110, 121. This is year 0, this is year 1, this is year 2, right? We convert, this is the present value, this 100 is present value today. This 110, 120, those are future values. Those are future values. We convert this present value into future values. This is called compounding. This is called compounding, right? Compounding means convert present value into future value. This is called compounding, right? If I ask you like this, to get 110, if you want to get 110, bank pay you 10% rate of interest. You need 110 in 1 year, right? The bank promise to give you 10%. How much you have to invest today? You need 110 in 1 year. Bank pays 10% interest. Then how much you have to invest today?
100.
100. So this is a process of future value, right? Future value to present value here. Future value to present value, right? So here, earlier what we do is we invest 100 and we forecasted the future value. That is called compounding. Now we have future values 110. Now we need to convert the present value. This is called discounting. Right? Discounting. It's clear? Compounding and discounting. Present value to future value is called compounding. Future value to present value is called discounting. Right? In your cash, when your project appraisal, you may see year and cash flow. Year cash flow. Year 1, year 2, 3, 4, 5. Right? Cash flow, you may have 10, 15, 25, 60, 40, like this. So can you tell me, so this is a present value or future value of cash flows? you will receive end of year 1, you will receive end of year 2. So these are future value or present value of cash flows.
Future values.
Yes, this is definitely future value, right? This is future value. Then we invest today. We invest today, year 0. Year 0, we invest today, certain amount, say 50,000, we invest today. And we are comparing this value in terms of future value. So there's a contradiction. And we have two values. One is present investment, our investment in present value, but cash flows in future value. We have to standardize. We have to standardize. We have two options. One option, we have to convert this present value into future value, and we have to compare this future value. This is one option. Second option, keep the present value as it is, and we have to convert this present value in future value into present value, right? These two options we have. Here we have a unique, we have a unique. Here we have a unique, but here there are a lot of discriminations. We compare our decision combination of present value and future value. It is not the ideal solution. It is not ideal, right? So we have to convert into a standard unit, right? We can't compare kilometer and meter, right? Meter and kilometer, no. So we have kilometer and kilometer, or meter and meter. So in that how we have to take decision, right? So what's the formula to so anyhow, right? The accepted term, right? Accepted term is we compare, right? Present value to present value. Present future value to future value, it is not recommended. Not recommended. So therefore, we have future cash flows, right? Stream of future cash flows, and we have to convert that future cash flows into present cash flows. That is called discounting. Discounting. And the discounting factor. Discounting factor. Discounting, converting, convert present value into convert future value into present value is called discounting. And we use a percentage, here we use 10%. This is called discounting factor. Discounting factor. In other way around, if we convert present value into future value, we call them as a compounding. And the rate we use to compound, it's called compounding factor, compounding rate. The rate called compounding factor, or the rate. Now let's move to the formula of compounding and discounting formula. The compounding equal, compounding mean we convert future value, present value to compounding. P, right? Present value into 1 plus R power n, right? This is the formula, compounding, right? Compounding. Then you can get future value. This is the formula, present value 1 plus R to the n. Say 100 rupees, right? So if you invest 100 rupees, 1 plus R is 0.1. You invest for 1 year, so it will be 110. So this is future value, and this is present value, right? Now, if anybody asks you to discount mean need to convert present value based on the future value. So what we do is So this is a formula. No? This is a formula. What we do is here present value 1 plus r to the power n equal future value. Same formula I have written. Same formula I have written. Right? Here what we do is we need present value. We need present value. What we do is future value. Right? This value comes here. 1 plus r n. 1 plus rn. So future value, we don't know that if we want to know, right, present value, right, already we know we need 110. We need 110 rupees in the future, and we know that bank pays 10% interest and for 1 year. Then how much present value? How much present value?
$100.
100. Present value 100. You see, 100. So this is a present value. 100 is a present value. 110 is a future value. So converting present value into future value, it's called compounding. Here we convert present value into future value, compounding, and from future value to present value is called discounting. And we have a formula. We have a formula is this. The formula, sorry, before that, for any scenario, this future value got changes. So this question, we have future value 110. Future value 110. In earlier question, we had present value 100. So in the questions, we don't know so what the amount is. So therefore, we need a formula. We need a formula. So we can take any value. We can take any value here. For example, future value into 1 plus, sorry, into 1 over 1 plus r n. So when you apply this here, future value is 110 into 1 over 1 plus r. 1 plus r mean 1.1. 1.1 into 1 year. It is 100 no. So the standard formula is standard formula. We can have any value here, but this is called discounting factor. Discounting factor. Discounting factor value here. So standard formula is convert discounting. Discounting mean the formula is 1 over 1 plus r to the power n. Right? 1 over 1 plus r to the power n. This is called PV, present value, equal 1 over 1 plus r. Right? R is rate of discounting rate, and n is number of period. So can you calculate? 15,000 at 15,000. This is a future value, can be taken in 2 years or in 5 years. In 5 years, what is the present value? So assume discounting factor, discounting rate, discounting factor is 10%. What's the right? You will receive 15,000 in 5 years. What's the present value of this 15,000 today? Please calculate quickly. Can you convert this 15,000 into present value? So we apply the formula. We apply formula is this. $15,000 We have to discount 1 over 1 plus R, that is 10, 1 plus 1, 1.1. How many years? 5. Then calculate present value. So this is the case. In 50 year, you will get 15,000. Then you have to convert this 15,000 future value into present value. This is year 0. So what is the value today? We have to discount it. So what's the value? What's the value of this 15,000 today?
$10,000.
Let us calculate. Right? Let us calculate. First, we have to take this portion. I will open the Excel site. So we have 15,000 receivable in 5 years. Bank pays 10% interest rate. 10% interest. So first, this is the future value. No, this is future value. We have to convert into present value. Present value. Right. Now, first we have to find out the discount effect there. Discounting, right? Discounting equal 1, right? Divided by 1 divided by 1 plus R. R, we know that this is the R. This is R. And how many period? So we should right, for 5 years. For 5 years. So discount effect is 0.2609. Right. This is the discount effect. Discounting. Right. Then so future value this now. Future value is this. This is discount effect for 5 years. Then 15,000 into the discount effect. For how much? The value of this 15,000 9,313.82. What happened if if you put 15 years? We will get this 15,000 in 15 years, but bank pays the same interest rate. So what is the future value to present value today? So it will increase or decreases present value. What do your expectation as a when you receive 50,000 5 years, today's value is 9,300 and so on. If you receive this 15,000 in 15 years, today's value is more than 9,000 or less than 9,000.
Less than 9,000, approximately 4,800 something.
Yes. If we do like this, this. Right? It's like 3,000. So its meaning is when someone offer you, I will give you 3,590, or I will give you 15,000 in 15 years. So those are both are equal, right? Rather than waiting for 15 years to receive 15,000, easily you buy just 3,050. So take it 50 years, right? If you take it 50 years, what's the value? Just 127 rupees. 127 rupees. Today's value, right? So this is how we have to convert the future cash flow into present cash flow discounting. Is it clear? If we invest 127, right? If you invest 127 today for 50 years, and you will get 15,000 in 50 years. See, this is the formula. 1 plus this is interest rate, no? Interest rate. For how many years? 50 years. How many years? 50 years. So this is the compounding. Then you see the value. So this is the amount you are going to invest, and this is the compounding factor. You see, 15,000. Right here, we convert present value into future value. That is compounding. Earlier, we convert this 15,000 into 127 present value, future value into present value. It is called discounting. Right? Is it clear? When they appraise project, so this is what time value of money concept. Time value of money concept. When you keep money in your hand, its value continuously lose its value. You don't want to spend that money. Automatically, it will depreciate its value. That's why if people having excess money, they convert the cash into gold to avoid this kind of depreciation, discounting of money. So it's essential consider time value of money. Right, it's clear. So keep remember this formula. This is the formula, right? 1 over 1 plus R rate of interest, the number of period. This is the value here. If someone asks you to discount this 12,500, 12,100 into present value, discounted is 10%. Then how? And for 2 years. So what we do is 1 plus R. This is R here 10%. No, if it is 15%, 0.15. 20% mean 20. Right? 25% mean 0.25. Then how many years? 2. Then we can get the discount effect, the value, right? So sometimes people use table, discounting factor table, present value table, right? Same value you can get the table, but you don't want to use a table. You can directly use this formula, right? So then only if you are clear, then only we can move to present value, the cash flow, NPV analysis, NPV and IRR, because those are heavily involved in discounting of cash flow. Future cash flow should be converted into present cash flow. Is it clear? So I can share your today's material. Please share your number, please. I can share today's material. Okay, I wind up the class now. If you have any questions, please let me know. Please WhatsApp me. I will share the today's notes. Okay, I will share. And stop sharing. If someone has sent me, I can share this materials, today's material, and next class materials, and today's material, and some exercises. Extracted text, extracted pages of textbook also I am sharing. Right, kindly share within the group. So textbook is a long file. Okay. Let us wind up the class. Thank you very much.
Thank you.
Welcome.
Thank you, sir.